Let's continue now with a major discussion here on equity style. Now, equity style and the material that I'm about to go over is a high priority for the Level 3 exam, and you should expect many times an essay and or some type of item set regarding style, equity styles. And I always tell Level 3 candidates, whenever you see something about styles or style indices or any kind of, keep your eyes attuned to that, because you'll see styles come up in different readings, even in performance evaluation. And you really do need to focus on that because that's a big focus on the Level 3 exam. Now, if you're using the curriculum books, I'm looking at pages 276 and 279. If you're using the prep providers materials, I'm addressing LOSs 25, G, and H, where you're being asked to justify the use of equity investment style classifications and discuss the difficulties in applying the style definitions. And then you're also being asked to explain the rationale and primary concerns for value investors and growth investors and the key risks associated with each of those styles. So they're really focusing here on three main categories of investment style. Number one, value investing. Number two, growth investing. And number three, sort of a combination of the two, market-oriented investing. But I would focus mostly on the value versus growth style. And that was actually the subject of an essay many years ago. We're talking about like 1996 here. But again, where they went full-blown, where they went head-to-head on this. But again, you'll see this a lot of times within the body of an essay, not an entire essay just about it. But in any case, when we're talking about the first type or first category of investment style, which is which is value investing, what do value investors actually focus on? Well, if you're looking at a price multiple, like price to book or price to earnings, they're focusing on the numerator, which is the price, okay? And whenever you think about value investing, think about Warren Buffett. What do they try to do? These value investors like Warren Buffett, they try to seek out what are usually considered to be low price to earnings, low price to book value, or if you will, low market value to book value, because price is the same thing as market value. So they seek out low price to earnings, low price to book value, low market value to book value, and high dividend yielding stocks. Okay, those are what they basically seek out. Now, as I go forward with this material a little bit more, what you should realize is that that's the focus of value investors. So if they do show you on an exam different types of investors, you should know based on a comparison of the PE for that investor with the overall market, what type of style they are following. Value investing or growth investing or what have you. Okay, two justifications for the value strategy. Why would someone want to pursue a value strategy? Well, they believe, for example, like many times, like Warren Buffett, that the firm's earnings are depressed temporarily. They are going to recover, and that the earnings will actually, as I just said, rise in the future. Why? Because just like ROE, earnings are supposed to be reverting to some mean level over the long term. In other words, you don't see a firm's earnings increasing forever and ever and ever, and you don't see it decreasing forever and ever unless it goes out of business. So we basically say that these types of investors, value investors, through value investing, expect the earnings of the depressed earnings of these companies to turn around, okay, and revert back to some mean level. And also, a lot of times what value investors will do is they'll say that growth investors are taking on too much risk, and that basically something cannot grow forever, and that they are paying too much for growth. And that eventually those growth stocks are going to contract. Now, you should also know with regard to value investing that there are three main sub-styles of value investing. Three main sub-styles, and I would make sure to know this. Number one, of value investing, number one is high dividend yields, as we mentioned before. Low price multiples, like low price to earnings, low price to book, and also contrarian, if you will, is a sub-style. What does contrarian mean? Doing the opposite of the market. If people are buying, you are selling. And if people are selling, you are buying. Contrarians. So value investors will tend to favor higher dividend yielding stocks because they expect that those high dividend yields will continue or will permeate or will continue into the future. Also, they seek out low price multiples because they believe that once the firm or the economy or the industry improves, so will the so will the stock, and there will be a following of an increase in the price of the stock and its value. And then when we talk about contrarian being a sub-style of value investing, contrarian investors tend to look for stocks basically that are temporarily too low or depressed. So that's the essence of value investing. Low priced earnings, low price to book, high dividend yield stocks, contrarian investing. The next type of, if you will, investment style or category of investment style is what we call growth investing. Growth investors are not going to focus on the numerator, they're going to focus on the denominator of price multiples, such as earnings or book value. So they focus on the denominator in the price earnings ratio, and they focus on, or they try to seek out companies or industries that have high expected earnings growth, and they expect that earnings to continue, and they look for this high earnings growth to drive the stock price, if you will, up even higher. So they're basically looking for what we call like momentum strategies to continue a momentum upwards. Now there are two types of sub-styles of growth investing. There's what we call a consistent earnings growth approach, and then we also have what is called a momentum or momentum stocks. Okay. Now, when we talk about a consistent earnings growth firm is going to continue to experience high growth in the future. So it's had high growth, and we expect as a growth investor that it's going to be consistent and it's going to continue into the future. That's what we call a consistent earnings growth, which is a sub-style of growth investing. On the other hand, momentum stocks, these are stocks that are expected to reverse in the future. We don't expect it to, as a portfolio manager, we don't expect it to continue going up forever, but we expect them to reverse in the future. But the portfolio manager actually holds the stocks as long as the momentum continues. And their whole idea is to basically sell the stock before the momentum reverses. So again, they have a record of high past earnings, these types of stocks, and stock price growth, but the manager, again, knows that it's not sustainable, so they will hold the stock in their portfolio as long as this momentum, this, if you want another word for momentum, would be the trend continues upward, and then hopefully sell it right before the trend reverses. The third type is what we call market-oriented investing. And that's really a strategy, if you will, or a style that is neither truly value nor truly growth. These types of portfolios resemble more like a broad-based market average. Okay? And if you're talking about sub-styles of market-oriented, if you will, investing, there are a few of them. Number one is a value tilt. Another one would be a growth tilt, where you have a tilt to growth. And another one would be GARP, growth at a reasonable price. And then the fourth sub-style is what we call rotation, style rotation. So you've got a value tilt as a sub-style, a growth tilt, growth at a reasonable price, also known as GARP investing, and style rotation. What do GARP investors basically do? They basically try to look for stocks or seek out stocks that have really, really good, positive growth prospects, but they are valued moderately. In other words, they're selling at moderate prices. They're not overvalued or too undervalued. They're selling at moderate values. Whereas style rotators, they basically select a style, whether it's growth or value, and then if they believe that that style is going to be popular in the future, they're going to follow that style. And once it falls out of favor, they will reverse or turn to another kind of style. In other words, they are seeking out the fad or the style that's in favor in the near future. So those are basically the three, if you will, categories of investment style.